I am Chris Pasnyaga, a market analyst here at Empire FX. This piece will look at the main catalyst for the financial markets this week with a focus on currencies, stocks, and commodities. This week focus in the currencies market will be on the Australian dollar, where the Australian Central Bank will deliver its interest rate decision on Tuesday morning. Expectations are that the bank will hike interest rates by 25 basis points to 4.35%. It will be the third interest rate this year, which is odd because other central banks are either leaving rates unchanged or hinting of a potential cut. The Australian dollar has jumped to the highest point since 2022 because of the carry trade opportunity that has emerged with the US interest rates being at 3.75 and Australian ones rising to 4.35%. The other currency to watch will be the Japanese yen, which jumped last week after the Bank of Japan intervened by pumping around $35 billion in the market after it dropped to the 160 limit. A weaker Japanese yen normally is good for Japanese exporters, especially now that there are tariffs with the US. So the weaker yen makes it cheaper for them to sell abroad. But also the challenge is the currency makes it very difficult for importers, especially now that the price of crude oil and energy have all gone up because of the war. The US dollar has been quite stable in the past few days. After the Federal Reserve left interest rates unchanged on Wednesday last week, with most officials preferring to leave them unchanged for a while. However, the decision was a bit dovish because some officials preferred to cut rates later this year. Meanwhile, in Europe, the pound and the euro are all largely unchanged after the Bank of England and the European Central Bank's decision last week. The two banks hinted that they will hike interest rates later this year because of the rising inflation. In the UK, inflation has jumped to 4.6%, and in Europe, it has gone up to around 3.8%. And chances are that they will continue going up because of the energy shortage and the rising energy prices. In the stock market, most indices today are largely flat, with the Dow Jones futures where they were on Friday, with the main reason being a statement by Donald Trump about the ongoing war. He said that the US will start escorting ships to cross the Strait of Hormuz. Well, that is a positive thing. The reality is that it will be very difficult for the US to escort ships because Iran also has a say about what is happening there. And Iran has proven to be a formidable force, especially in the drone warfare and short missile. So this week, the stock market will mostly depend on the earnings season, where many companies, especially in the tech industry, will publish their earnings. Most notably will be Palantir, which will report today, AMD, which will report tomorrow, and companies like Disney. The earnings season has been quite good with the earnings growth coming at around 27%, much higher than what analysts were expecting. They were expecting around 13%. So the soaring growth, especially in the technology industry, has helped to offset the rising geopolitical tensions that are going on. The same thing is happening in the energy market, where oil is a bit down today, because of Trump's statement about the Strait of Hormuz and his statement that the US and Iran were still talking. But Trump's statements should be taken with a grain of salt, because of late his statements are largely focused on moving the market. So for instance, when you look at the talks, the reality is that the US and Iran are too far apart, and it's unlikely that they will reach a deal this week. In the precious metals market, gold, silver continue to move sideways. Part of the reason is that investors are dumping their ETFs. The popular GLD ETF is down 3.4 billion this year, while the SLV is also down around 1.6 billion this year. On the other hand, these funds probably have gone back to the equities market, with the S&P 500 ETFs gaining over $50 billion in inflows this year.